When it comes to venture-backed startups, an exit isn't just a milestone, it's the ultimate goal. Unlike traditional businesses that can operate profitably for decades, startups fueled by venture capital are built for rapid growth, with the expectation that they will eventually reach a liquidity event. This is the point where venture investors see a return on their capital, and founders and employees convert years of effort and equity into real financial outcomes. But the real question isn't just if a startup will exit, it's how and when. Some take the high-profile path of an initial public offering, IPO, tapping into public markets to scale further. Others are acquired, joining larger companies to accelerate strategic growth. Some investors and early employees opt for secondary sales, selling shares privately while the company remains independent. And in rare cases, startups may undergo a management buyout, where founders or executives regain control by purchasing investor stakes. Each of these paths requires careful planning, and none are guaranteed. Market timing, investor expectations, company performance, and founder vision all shape which exits are viable and when. A well-executed exit doesn't just maximize returns, it ensures a smooth transition, long-term value creation, and strategic continuity for the business. And here's where things get complicated. Exits may be the goal, but they're rarely under full control of the startup. External factors like macroeconomic shifts, public market volatility, or changes in buyer appetite can open or close exit windows unexpectedly. That's why savvy founders and venture capitalists treat exit planning not as a one-time decision, but as an ongoing strategy built into the company's roadmap from the beginning. On average, venture-backed startups take 7 to 10 years to reach a successful exit. Some move faster within 3 to 5 years, especially when early-stage acquisitions arise due to unique technology, talent, or market positioning. Others follow a more traditional route, raising multiple rounds and scaling over time before an IPO or a large acquisition. And in deep tech, biotech, and other capital-intensive industries, exits can take more than a decade, requiring unusual patience and long-term capital. But here's the challenge. While startups operate on organic timelines, venture capital firms run on fixed fund cycles, usually 10 years. That creates built-in pressure for liquidity, especially as funds approach their end of life. VCs often face situations where the company is still growing, but the fund needs to return capital to its limited partners. This misalignment between a company's trajectory and an investor's timeline can force difficult decisions. To bridge this gap, experienced investors are increasingly using tools like secondary sales, which allow founders, employees, or early investors to cash out part of their holdings without requiring a full company exit and continuation vehicles. We're promising, but illiquid companies are spun out into a new fund, giving existing LPs a chance to exit while allowing the company more time to grow. These strategies reflect a growing recognition that exit timing must balance 3 dimensions: company readiness, market conditions, and investor timelines. A startup may be hitting milestones and gaining traction, but if the IPO window is closed or merger and acquisitions activity is slow, forcing an exit could destroy value. The best founders and the best VCs prepare for this. They think about exit timing early, not just in terms of when can we sell, but when will this create the most value for everyone involved? They structure their boards, cap tables, and internal processes to remain flexible, and they work to stay exit ready long before a deal is on the table. Because in venture capital, a great exit isn't just a finish line, it's a strategic move that requires foresight, alignment, and impeccable timing. An initial public offering, or IPO, is often seen as the most prestigious exit route. It's the moment when a company lists its shares on a public stock exchange, opening the door to massive funding opportunities, increased brand credibility, and liquidity for investors and employees. But while an IPO can be a game changer, it comes with significant challenges. Public companies face strict regulatory and compliance burdens, quarterly earnings pressure, and the unpredictable nature of the stock market. Investor sentiment, economic conditions, and industry trends all influence a company's post-IPO success. That's why the timeline for going public is so important. Most venture-backed startups that reach IPO status do so after at least 7 to 10 years of growth, though some industries, like biotech, tend to go public earlier. And in recent years, alternative paths to going public, such as direct listings and SPACs, the special purpose acquisition companies, have provided new ways for startups to access public markets with fewer hurdles. While an IPO offers the largest financial upside, it's only a viable option for companies that have achieved significant scale, revenue traction, and a strong competitive position. For most startups, a merge or acquisition deal is the more likely path. In a merger or acquisition, a larger company purchases a startup for its technology, talent, or market presence. Some deals are strategic, where the acquiring company integrates the startup's product into its ecosystem. Others are purely financial, where investors buy the startup for its growth potential. And in some cases, an acquisition is more about acquiring the team itself. The appeal of an M&A exit is its speed and efficiency. Unlike IPOs, which require years of preparation and regulatory approvals, acquisitions can happen at any stage, even as early as 3 to 5 years after a company is founded. That said, the terms of an acquisition matter just as much as the deal itself. Founders and investors must evaluate whether the offer is cash, stock, or a mix of both. They must also consider cultural fit. Will the startup's mission align with the acquiring company? And what happens to the team? Will the founders and employees stay on, or will they transition out? For many startups, an acquisition exit provides a strong financial return with fewer risks and complexities than an IPO. Not all exits happen in one big moment. In some cases, founders, early investors, and employees may seek liquidity before an IPO or acquisition. This is where secondary sales come in. A secondary sale allows existing shareholders to sell part of their stake in the company to new investors without waiting for a full exit. This is especially common in startups that are staying private longer but still need to provide liquidity to early investors or employees. Companies like Stripe, SpaceX, and Databricks have facilitated secondary sales to allow insiders to cash out while maintaining growth momentum. These transactions can be beneficial, but they need to be carefully structured to avoid disrupting future funding rounds or sending the wrong market signals. In rare cases, startups pursue a management buyout, or MBO, where the company's leadership team buys back shares from investors, effectively taking control of the company. This typically happens when a startup has become profitable and no longer needs outside capital. Sometimes, venture investors are looking for liquidity, but an IPO or a merge and acquisition deal isn't on the table. In these scenarios, the founders may decide to take the company back under their full control. While MBOs are uncommon in the venture world, where most startups are structured for high-growth exits rather than long-term ownership, they can be a viable option in cases where a company transitions from being a high-growth startup to a sustainable, privately held business. Ultimately, startups don't always get to dictate exactly when or how they exit, but they can shape how ready they are when the opportunity arrives. The strongest companies prepare for multiple scenarios by building not just for growth, but for exit flexibility. That means clean cap tables, well-structured governance, robust financial reporting, and a clear understanding of what different exit paths require. The right exit strategy depends on a combination of factors: revenue scale, capital efficiency, investor return expectations, the competitive landscape, and the personal goals of the founders. Some startups pursue an IPO to cement their market leadership and gain access to public capital. Others view a strategic acquisition as the fastest route to scale or product integration. Some rely on secondary transactions to provide interim liquidity for founders and early employees without triggering a full company exit. A few may pursue a management buyout, especially when founders want to regain control or shift direction. Crucially, VCs and founders must stay aligned throughout. Fund timelines, exit expectations, and company maturity don't always sync naturally, which is why some investors now use continuation vehicles or support structured secondaries to extend value creation while still delivering liquidity to LPs. The key is to remain agile, ready to evaluate all options, and willing to adapt the exit path as conditions evolve. Because the best exits aren't just opportunistic, they're intentional, aligned with both near-term financial goals and the company's long-term mission. In venture capital, an exit isn't just a liquidity event. It's a culmination of strategy, execution, timing, and alignment. It reflects years of value creation, but it also sets the stage for what comes next. For founders, it can be life-changing. For VCs, it's the moment when value is realized and reputations are solidified. But exits don't just happen. Great VCs work with startups early to build exit readiness into the company's DNA. That means helping founders become IPO ready even if they end up pursuing an acquisition. It means guiding governance, financial discipline, and equity structuring in ways that make the company attractive to future buyers or public investors. And it means ensuring that secondaries, continuation funds, or other liquidity strategies are used wisely, preserving upside while solving for real-world constraints. More importantly, VCs play a key role in orchestrating the exit. That includes identifying potential buyers, engaging bankers and advisors, negotiating deal structures, and ensuring that all stakeholders, employees, founders, and LPs are treated fairly and strategically. Because in venture capital, a successful exit isn't just about getting out, it's about setting up what comes next. Done well, an exit fuels the next wave of innovation, strengthens relationships, and enhances the long-term reputation of both the company and the investors behind it.